If you have money in a US bank right now, listen carefully. In one single week last October, $102 billion just vanished from US banking reserves. Not stolen, not lost in some crypto scam. Just gone. This is the steepest, most violent drop in bank liquidity since the COVID panic of 2020. And here's what should terrify you. Those reserves, that $102 billion, that's not just some abstract number on a Federal Reserve balance sheet. That's the actual cash cushion that allows your bank to process your withdrawal when you walk up to the ATM. It's the engine oil in the financial system. And right now, we're running on fumes. By the end of this video, I'm going to show you leaked Federal Reserve data proving that while you were opening Christmas presents, the Fed was panic wiring $17 billion to Wall Street banks in the middle of the night. I'm going to show you why top analysts at JP Morgan are quietly building a $2.2 billion war chest for what's coming. And I'm going to explain why the very same pattern that killed Silicon Valley Bank in 2023 is now happening across the entire US banking system. Except this time, it's 40 times larger. This is economy decoded. We don't sugarcoat it. We don't parrot whatever CNBC tells you. We follow the data. And the data right now is screaming. Let's decode what's really happening. Here's what they're not telling you on the evening news. U.S. bank reserves, the actual liquid cash that banks hold at the Federal Reserve, crashed to $2.87 trillion in October 2025. That's a 4-year low. To put this in perspective, back in January 2024, those reserves sat comfortably at $3.4 trillion. In just 9 months, nearly $600 billion evaporated. That's the fastest liquidity drain since 2019. Think of bank reserves like engine oil in your car. Your car might look fine sitting in the driveway. The paint's shiny. The tires are inflated. But if there's no oil in the engine, the second you turn that key and start driving, the whole thing seizes up. That's exactly where we are with the banking system right now. Now, the Federal Reserve has a threshold, a red line they've drawn called ample reserves. That number is $2.8 trillion. Below that level, the financial system starts to break. ATMs stop working smoothly. Banks can't process transfers efficiently. Credit markets freeze up. In October, we hit $2.87 trillion. We were $70 billion away from the danger zone. That's like being one missed paycheck away from eviction, except the tenant is the entire US banking system. And here's the kicker. There used to be a safety valve. It's called the Reverse Repo Facility, the RRP. This was basically a parking lot where banks and money market funds could park excess cash overnight with the Federal. At its peak in December 2022, this facility held over $2.5 trillion. It was our shock absorber. Today, it's down to $318 billion. That's a 91% collapse from the peak. By some estimates, it could hit zero within months. What does that mean in plain English? It means the backup generator is gone. Every future dollar of liquidity that needs to be drained from the system now has to come straight out of bank reserves, the very reserves that are already critically low. This isn't a theory. This isn't a prediction. This already happened. And the Fed's response? They blinked. On October 29, 2025, the Federal Reserve quietly announced they were ending quantitative tightening, their fancy term for draining money out of the economy. Why? Because they saw this chart. They saw the cliff. And they panicked. Don't take my word for it. Jamie Dimon, the CEO of JP Morgan Chase, the biggest bank in America, warned during his January 13th earnings call that low liquidity could lead to serious volatility. JP Morgan then immediately built a $2.2 billion reserve as a defensive cushion against what they see coming. Kathy Wood from ARK Invest was even more blunt back in April 2025. She said, and I quote, "Asterisk, this crisis is calling out for some kind of Mar-a-Lago accord on free trade, in tandem with serious support from the Federal. No more time to waste. Asterisk." And then there's Zero Hedge, who published a bombshell analysis in December titled, "The Biggest Liquidity Drain in the World is About to End." They reported that the Fed had removed $2.4 trillion from the financial system since June 2022. Their exact words, asterisk, behind the scenes, the U.S. banking system is experiencing a mini funding crisis. Asterisk now, before you rush to pull all your cash out, and I'm not saying you should, let me give you the full picture. As of January 14th, 2026, Reserves have recovered slightly to $3.06 trillion. That's about $180 billion higher than the October bottom. So the immediate emergency has been contained. For now. But here's what you need to understand. We went from comfortable reserves to the edge of a cliff in 9 months. The Fed had to completely reverse their policy to stop the bleeding. And we're still only $260 billion above the danger zone. This isn't stability. This is a ticking time bomb with the timer paused. And what I'm about to show you next proves that behind the scenes, the panic is very, very real. Here's where this story gets disturbing. While the mainstream media was running puff pieces about resilient economic growth, the New York Federal Reserve was quietly executing emergency cash infusions to Wall Street banks. And I'm not talking about normal operations. I'm talking about massive, unprecedented injections of cash that broke a 5-year pattern of silence. Let me give you the exact dates and amounts. October 31st, 2025, the New York Fed wired $51 billion to banks. December 25th, 2025, Christmas morning, 8 a.m., $17 billion. December 29th, 2025, Sunday evening at 5 p.m., when banks are closed, $34 billion. Let that sink in. While you were opening presents with your family on Christmas morning, the Federal Reserve was panic wiring $17 billion to banks that were running out of cash. From June 2025 to January 2026, just 7 months, the Fed injected over $420 billion in emergency lending. For context, they had gone 5 years and 3 months with virtually no such activity. This data comes from investigative reporting by Report's economics correspondent James S. Henry, who monitors Federal Reserve repo operations. These aren't conspiracy theories. These are publicly available Federal Reserve records that nobody in the media bothered to report. And it gets worse. On December 31st, the final trading day of 2025, banks borrowed a record $74.6 billion from the Fed's standing repo facility in a single day. That shattered the previous record of $50 billion set just 2 months earlier in October. Where did that money go? The Fed doesn't tell us. By law, they keep the names of borrowing banks secret for 2 years to avoid stigma and market panic. But think about what that means. There are banks in this country, right now, that are so desperate for cash they're borrowing tens of billions of dollars overnight just to keep the lights on. And we don't know which ones. Now here's the part that should make your blood run cold. On December 10th, 2025, the New York Fed quietly removed the caps on emergency lending to the banking industry. Previously, there was a $500 billion aggregate limit on how much banks could borrow. Now, individual banks can borrow between $80 billion and $240 billion per day, depending on size. Why would regulators remove lending limits unless they expected bigger and more frequent bailouts ahead? They're preparing for something. And before anyone in the comments says, but the Bank Term Funding Program can handle this. No, it can't. The BTFP, which was created after Silicon Valley Bank collapsed in 2023, expired in March 2024. It's gone. That safety net no longer exists. So to recap, reserves are critically low. The backup facility is 91% empty. Emergency lending is spiking to record levels. And the Fed just removed the cap on how much they can bail out banks. If this sounds like the setup to 2008, you're not wrong. But the scale of what's hidden on bank balance sheets right now makes 2008 look like a practice run. Let's talk about the elephant in the room that makes all of this exponentially worse: U.S. national debt. As of January 7th, 2026, the United States national debt hit $38.43 trillion. That's not a projection. That's not a worst-case scenario. That's the actual number right now. Here's how fast that number is growing. $8.03 billion per day. $334.48 million per hour. $5.57 million per minute. $92, $9.12 per second in the time it takes you to watch this 25-minute video. The U.S. national debt will increase by roughly $139 million. Now, you might be thinking, okay, but debt has always been high. Why does this matter for banks? Here's why. In 2020, the U.S. government paid $345 billion in interest on the national debt. That was already a lot, but interest rates were near zero back then. Today, with rates higher, the U.S. is paying over $1 trillion per year just in interest payments. In the first 9 weeks of fiscal year 2026 alone, We've paid $104 billion in interest. That's $11 billion per week, every single week. To put that in perspective, we're now spending 15% of the entire federal budget just on interest. That's more than we spend on defense, more than we spend on education, more than most social programs combined. And here's how this connects to the banking crisis. When the government is drowning in debt and can't afford the interest payments, there are only two options: cut spending massively, which is political suicide, or print more money. Guess which one they always choose? When the Fed prints money to keep the government afloat, that money floods into the economy. It devalues every dollar you've saved: your retirement account, your emergency fund, your kids' college savings. All of it loses purchasing power. This is the death spiral. Debt forces money printing. Money printing causes inflation. Inflation makes everything more expensive. More expensive government means more debt. And the cycle continues. And the banks? They're stuck in the middle of this nightmare, holding hundreds of billions of dollars in treasury bonds and mortgage-backed securities that are losing value every single day. Which brings me to the scariest number in this entire investigation. Remember Silicon Valley Bank? In March 2023, SVB collapsed in less than 48 hours. It was the second largest bank failure in U.S. history. The reason it failed? Unrealized losses. SVB was sitting on $15 billion in losses on its securities portfolio, bonds and mortgage-backed securities that had plummeted in value as interest rates rose. When depositors found out, they panicked. $42 billion was withdrawn in a single day. The bank couldn't sell its assets fast enough without locking in those losses. It collapsed. Now, here's the part that should keep you up at night. The entire U.S. banking system today is sitting on over $600 billion in unrealized losses. That's 40 times larger than what killed Silicon Valley Bank. These aren't small community banks. These are major regional institutions holding trillions in deposits. They bought long-term treasury bonds and mortgage-backed securities back when interest rates were near zero. Now that rates have spiked, those securities are worth far less than what the banks paid for them. Here's the accounting trick. As long as banks classify these securities as held to maturity, they don't have to mark the losses on their books. It's like saying, yes, my house is worth $200,000 less than I paid for it, but I'm planning to live here forever, so I don't have to acknowledge the loss. That works until you need to sell. And what forces banks to sell? Depositor withdrawals. If customers start pulling their money out, whether due to panic, higher yields elsewhere, or just needing cash, banks have to liquidate assets. And the second they sell those bonds at a loss, the loss becomes real. Capital evaporates. The bank becomes insolvent. This is why some analysts are calling them zombie banks. They're technically alive on paper, but they're walking dead. One shock, one loss of confidence, and the whole structure collapses. Now, before I get accused of fear-mongering, let me be clear, accounts are not frozen right now. There is no evidence of widespread withdrawal limits or bank runs as of January 18, 2026. In fact, the SBDR Regional Banking ETF, ticker symbol KRE, which tracks regional bank stocks, is trading near its 52-week high at around $68. That's up 45% from its April 2025 low. Regional banks have rallied over 11% in the past 3 months. So the market is saying everything is fine. But the balance sheets are saying the opposite. This is the strange paradox we're in. The stock market is rallying. Earnings reports from JP Morgan and Goldman Sachs beat expectations. Investment bankers are optimistic about 2026. But underneath the surface, the structural fragility is worse than it was in 2008. We're the Titanic, and everyone on deck is partying. But below the waterline, we've already hit the iceberg. The question isn't if this becomes a crisis. The question is what triggers it. So where does this go from here? There are 3 possible scenarios. Scenario 1, the slow bleed, most likely. The Fed continues to manage this crisis behind the scenes. They keep reserves just above the danger zone. They provide emergency lending quietly. Banks slowly work through their unrealized losses over years by letting bonds mature without selling them. Inflation stays elevated. Your savings lose 3 to 5% of purchasing power per year. But there's no dramatic collapse, just a grinding erosion of wealth. This is what they're hoping for. And honestly, it's the most probable outcome in the near term. Scenario 2, The controlled implosion possible. A handful of regional banks fail over the next 12 to 24 months. The FDIC steps in, merges them with larger institutions, and insures depositors up to $250,000. We see a repeat of the 2023 crisis with Silicon Valley Bank and First Republic, but on a slightly larger scale. Markets panic temporarily, then stabilize. More consolidation happens. The big banks get bigger. This would be painful but manageable. Scenario 3. The cascade, low probability, catastrophic impact, a major shock hits the system. A geopolitical crisis, a sudden spike in interest rates, or a loss of confidence in a top 10 bank. Depositors panic. Bank runs begin. The $600 billion in unrealized losses gets crystallized as banks are forced to sell assets. The Fed steps in with massive bailouts, but it's too late. Credit markets freeze. ATMs go offline. The government imposes temporary withdrawal limits for stability. This is the 2008 scenario, but bigger. Isn't likely in the next 90 days? No. The Fed has shown they'll intervene before it gets that bad. But is it possible in 2026 or 2027 if the wrong triggers align? Absolutely. Here's what you need to understand. This is not a conspiracy. This is math. This is publicly available Federal Reserve data, bank balance sheets, and analyst warnings from the biggest financial institutions in the world. The system is fragile. The reserves are thin. The debt is exploding. And the emergency lending is spiking. Everything I've shown you in this video is documented, sourced, and verifiable. So what do you do with this information? First, don't panic. Your money in FDIC-insured accounts up to $250,000 is protected. The government will print money to make depositors whole if a bank fails. They prove that with SVB. Second, diversify. Don't keep all your money in one bank. Spread it across multiple institutions. If you have more than $250,000 in cash, make sure it's distributed so each account is under the FDIC limit. Third, consider tangible assets. This isn't financial advice. I'm not a licensed advisor. But historically, when currency loses value, people move to hard assets. Gold hit record highs in 2025. Silver tripled in price to $93 per ounce. Real estate holds value. These are worth researching. Fourth, build an emergency fund. If credit markets freeze, you want 3 to 6 months of expenses in cash that you can physically access. Not just in a bank account, but actual currency you can hold. Fifth, stay informed. This situation is evolving. The Federal Reserve releases data every week. Watch the H.4.1 report. Monitor bank reserves. If you see them dropping back toward $2.8 trillion, that's your canary in the coal mine. If this video helped you understand what's really happening in the banking system, hit that subscribe button. We're the only channel giving you the unfiltered truth that mainstream media won't touch. Drop a comment below. Do you think we're heading for another 2008? Or is the Fed going to manage this without a collapse? And here's the most important thing you can do. Share this video. Your friends, your family. People need to know what's happening with their money. The banks won't warn you. The media won't warn you. But the data is screaming. $102 billion vanished in 1 week. $600 billion in hidden losses. $38.43 trillion in debt, growing by $8 billion per day. This is economy decoded. We follow the data. And the data says, prepare. Important disclaimer. Everything in this video is for educational purposes only. This is not financial advice. I am not telling you to buy, sell, or do anything with your money. I'm presenting publicly available data and analysis. You are responsible for your own financial decisions. Consult with a licensed financial advisor before making any major changes.